Absolutely. I think, these low default rates that we've observed last year and the forecast at 2.5%, as you mentioned, for this year are absolutely not, the reflection of stronger credit than, in previous crises. Actually, one risk that we've flagged entering the pandemic and we continue to flag is that we have a very high share of vulnerable credit. We have almost 30% of speculative grade credit rated B- and below, which is at the lower end of the rating scale. And as you mentioned, this means that there are risks and vulnerabilities to changes in financial and economic conditions. So the low default rates are reflecting two things. One is the stunning economic rebound in 2021, which has really benefited a number of corporates. And as well, as you mentioned, this ample liquidity and very low, very favorable funding conditions through the CCC category. Investors have bought over $1 trillion in high yield and leveraged loan debt just in the US in 2021, which is staggering. But indeed, getting into next year, one of the key risks that we underline in our report is that this persistently high inflation could push central banks to act more aggressively in this normalization on financing condition, and that would impact on this more vulnerable credit at the bottom end of the scale.
Alexandra, if we talk about the Fed specifically, we've seen the bond market now bringing forward the chance of a March rate hike. We've already had a number of participants warn that any Fed exit could cause a little bit of noise in credit markets, perhaps cause some stress in certain quarters. What sort of activity from the Fed would cause some stress, whether it's timing around the first hike or whether it's a series of hikes this year?
Well, I think just to start with, we expect a normalization of the funding condition. And as the economy strengthens, it is a normal path that central bank would gradually raise their rate and rebuild some margin of maneuver for the following crisis. So from a credit standpoint, we're not worried about a normalization of funding conditions. So the risk is if this tightening is more aggressive, abrupt, than market would expect, leading to sharp repricing risk or change in market sentiment. And this is where all of this credit at the bottom end of the rating scale or emerging market could suffer more pressure. It's important, though, to also keep in mind that I mentioned the $1 trillion of high yield debt and leverage loan last year. Half of that was used for refinancing and repricing. So a lot of the corporate have used these very favorable funding conditions to extend their maturities, lower the pricing of their debt. So that gives a little bit of a buffer, but still this is a top risk that we're watching for 2022.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.